Get ready because the financial world is buzzing, and we've got the inside scoop on all the seismic shifts happening right now. From groundbreaking global experiments to the sharpest minds in the digital asset space, this is not a show you want to miss. We're diving deep into the stories that are reshaping how we think about money, investment, and the future of finance. Buckle up, because the news cycle is moving faster than ever, and Bitcoin Bulletin is here to break it all down for you. We've got a packed show today, so make sure you stay tuned for all the essential updates. You do not want to miss a single second of this. Let's get right into it. First up, we're heading to El Salvador to uncover the real-world impact of their bold Bitcoin experiment. What have they learned? What are the challenges? And what does this mean for countries everywhere considering this path? We're getting into the nitty-gritty of this historic adoption. Then, we're shifting gears to hear from a leading voice in the crypto custody world. The CEO of Hex Trust is weighing in on the burgeoning trend of companies putting Bitcoin on their balance sheets. Is it a smart move for diversification, or is there a hidden danger lurking beneath the surface? We'll explore the promise and the peril. Next, we're tracking major movements within the Bitcoin ecosystem itself. Long-term holders are making significant moves, shifting massive amounts of BTC. What does this signal for the market? We're analyzing the data and what it means for the price action ahead. And finally, we're looking at the broader market sentiment and how it's affecting Bitcoin's resurgence. We'll break down the dynamics of ETF flows and how they're influencing the overall market, especially in the wake of altcoin season. Get ready for all the insights. Don't forget to smash that like button, subscribe if you haven't already, and ring that notification bell so you never miss an update. Let's go. El Salvador's Bitcoin experiment, a global lesson. El Salvador's pioneering move to adopt Bitcoin as legal tenderback in 2021 wasn't just a national decision. It was a global statement, setting a precedent that continues to spark intense debate about the future of finance and cryptocurrency adoption. As the very first nation to integrate a digital asset in such a profound way, El Salvador's journey offers a unique, real-world case study. This deep dive explores the critical lessons learned, focusing on the delicate balance of government control over digital assets, the ambitious pursuit of financial inclusion for its citizens, and the ripple effects on established traditional banking systems. When El Salvador embarked on its Bitcoin path, the primary objective was to extend financial services to the vast 70% of its population that remained unbanked. The chosen vehicle for this ambitious plan was the Chivo wallet. However, the rollout and subsequent adoption faced significant headwinds and public skepticism. Contrary to initial hopes, adoption didn't soar. Surveys conducted post-implementation revealed a stark reality. Nearly 68% of Salvadorans expressed opposition to Bitcoin as legal tender, largely preferring the familiarity and stability of cash transactions. Despite government incentives, like a $30 bonus for downloading the Chivo wallet, the active user base saw a rapid decline, falling below the 20% mark shortly after the initial push. This experience offers a potent illustration of the potential pitfalls when governments become deeply involved in the cryptocurrency space. In environments where systemic corruption is a concern and regulatory frameworks are still in their nascent stages, such direct involvement can erode investor confidence and introduce a degree of economic instability. For emerging markets, in particular, the absence of robust, clear regulations can inadvertently create an environment where unregulated entities gain dominance, fostering public distrust and increasing the susceptibility to scams and fraudulent activities. The inherent volatility of Bitcoin itself presents another layer of risk. When coupled with a lack of stringent regulatory oversight, this volatility can deter potential investors and lead to unpredictable policy shifts that can derail even well-intentioned crypto projects. El Salvador's journey serves as a crucial cautionary tale for any nation contemplating a similar strategy, underscoring the absolute necessity for comprehensive regulatory frameworks designed to protect investors and ensure overall economic stability. Despite these considerable challenges, the potential for Bitcoin to significantly enhance financial inclusion in developing nations remains a compelling prospect. with an estimated 1.4 billion people worldwide still lacking access to basic banking services, many residing in regions with limited traditional financial infrastructure. Bitcoin offers a viable alternative. Through just a smartphone and internet connection, individuals can gain the ability to store, send, and receive funds, effectively bypassing the barriers of traditional banking. Furthermore, Bitcoin holds the promise of reducing the often exorbitant fees associated with remittances, a lifeline for many migrant workers sending money back to their families. By lowering these costs, more financial support can reach households, potentially alleviating poverty and improving living standards. El Salvador's initiative also presents a direct challenge to the established order of traditional banking systems, particularly in regions like Asia and Europe. By establishing Bitcoin as legal tender, the nation has effectively created an alternative financial pathway that bypasses conventional intermediaries. This move compels banks and regulatory bodies worldwide to reassess their strategies concerning digital currencies and the broader landscape of financial innovation. As the global financial environment continues its rapid evolution, traditional banks face mounting pressure to adapt and offer cryptocurrency-related services to meet growing customer demand. El Salvador's bold foray into Bitcoin serves as a significant wake-up call, highlighting the imperative for financial institutions to embrace innovation and demonstrate adaptability in an increasingly digitized economy. The lessons learned from El Salvador's experience are invaluable for any nation considering a similar path, emphasizing the critical need for a carefully considered and robustly regulated approach to harness the potential benefits of cryptocurrencies while mitigating the inherent risks. So, what's the next big move in the corporate crypto adoption game? Stay tuned as we dive into the promise and peril of companies putting Bitcoin on their balance sheets. HexTrust CEO on Bitcoin treasury firms, promise and peril. In the fast-paced world of digital assets, the concept of digital asset treasury, DATS, companies strategically placing Bitcoin on their corporate balance sheets, has emerged as a dominant topic of conversation, particularly highlighted at recent industry events like BTC Asia in Hong Kong. Alessio Quaglini, the CEO and co-founder of HexTrust, a prominent crypto custodian, offers a nuanced perspective on this growing trend, viewing corporate Bitcoin treasury holdings as a development with both significant promise and considerable peril. Quaglini articulated his views during a recent interview on the sidelines of BTC Asia, emphasizing the positive implications for broader adoption. It's great for the adoption. It's great because you have basically indirect Bitcoin access to billions of people investing in local stock exchanges and Nasdaq, he stated. This perspective suggests that when publicly traded companies incorporate crypto into their financial structures, it provides a gateway for a vast number of investors who may not directly engage with crypto markets to gain exposure through their traditional stock investments. However, Quaglini draws a critical distinction between healthy diversification strategies and what he terms financial engineering. He elaborated, if this listing company exists for the sole purpose of holding crypto, well then, it's a hedge fund that is publicly traded. It's a financial engineering kind of exercise. This highlights a concern that some companies might be using Bitcoin not as a genuine treasury management tool or a hedge against inflation, but rather as a speculative vehicle, potentially masking the true nature of their operations. A primary concern voiced by Quaglini, echoing sentiments across the industry, revolves around the excessive use of leverage. Citing a report from Galaxy, he pointed to loan volumes reaching their highest levels since 2022, accompanied by a significant liquidation wave totaling $1 billion. This leverage-fueled activity has already prompted regulatory intervention in some jurisdictions, with Korean regulators stepping in to freeze new lending products due to concerns about market stability being strained by leveraged positions. If these companies deploy leverage, and they issue debt to buy Bitcoin with strong triggers, then it's a big issue, Quaglini warned. He explained that in public markets, debt covenants are typically transparent, allowing traders to anticipate potential forced selling events. This transparency can lead to a prisoner's dilemma scenario, where the anticipation of selling pressure can create a cascading effect, amplifying market volatility. This is particularly concerning if companies are using borrowed funds to acquire Bitcoin, as a downturn could trigger margin calls and forced liquidations, creating a downward spiral. Despite these cautionary notes, Quaglini views the current wave of Treasury players as a foundational step. He anticipates a more significant development. The next step is that you have real companies that do have a lot of operating cash flow, and they're sitting on huge amounts of cash, like Apple, Google, etc. If such tech giants were to allocate even a small portion of their substantial cash reserves into Bitcoin, Quaglini believes the impact would be extremely positive, signaling a profound level of institutional acceptance and trust. Ultimately, the true test of the viability and sustainability of DATs, according to Quaglini, lies not in smaller firms acting as Bitcoin proxies, but in the willingness of the world's largest corporations to integrate Bitcoin into their core financial strategies by placing their significant cash reserves on-chain. This would represent a monumental shift in mainstream financial acceptance. Are these large corporations ready to make the leap into Bitcoin? We're now turning our attention to the movements of long-term Bitcoin holders and what their actions signal for the market. Bitcoin long-term holders shift 97K BTC in major 2025 outflow. In a significant development for the Bitcoin market, long-term holders, LTHs, dramatically increased their activity late last week, moving approximately 97,000 BTC in a single day. This marks the largest one-day outflow of Bitcoin from LTHs observed throughout 2025, according to data from blockchain analytics firm Glassnode. While this surge in selling activity has captured market attention, Glassnode notes that the overall trend remains within the typical parameters of the current market cycle, falling short of the massive distribution spikes witnessed in late 2024. Analyzing the distribution by coin age, Glassnode reported that approximately 34,500 BTC were moved by holders who had possessed the asset for between 1 to 2 years. Another 16,600 BTC came from those holding for 6 to 12 months, and 16,000 BTC were moved by holders in the 3 to 5 year bracket. Collectively, these age cohorts accounted for roughly 70% of the total outflow on Friday. This notable outflow occurred as Bitcoin's price hovered near the $109,000 mark on Monday, following a weekend dip to the $107,000 area amidst broader market jitters. This price action follows a mid-August rally that saw Bitcoin briefly touch a record high above $124,000, leaving the digital asset trading approximately 12–14% below its peak. The shift in LTH behavior coincided with a risk-off sentiment in the ETF market on Friday. U.S. spot crypto ETFs experienced net outflows, with Bitcoin funds seeing approximately $127 million exit and Ethereum funds losing around $165 million. This represents a reversal from the positive inflow trends observed earlier in August. Farside's daily ledger data further indicated that the final trading sessions of August featured mixed performance and a notable negative day on August 29th. Glassnode's recent analyses have highlighted that long-term Bitcoin investors have already realized substantial profits during the current cycle, exceeding the gains seen in the 2021 cycle, although still trailing the peak performance of the 2017 cycle. This context helps explain why periodic waves of LTH distribution can occur around periods of price volatility without necessarily disrupting the fundamental structure of the ongoing bull cycle. Such distributions are often a natural part of profit-taking for early investors. Crucially, Glassnode's latest Week On-Chain report identified key tactical price levels for Bitcoin. It noted support in the $107,000 to $108,900 band, which was being tested, potential resistance near $113,600, and a more significant downside zone between $93,000 and $95,000 should selling pressure intensify. The LTH selling on Friday directly contributed to the price movement towards the $107,000 level, especially when combined with the negative ETF flows. If Bitcoin can successfully reclaim the $113,000 to $114,000 range, it would signal that the market has absorbed the supply released by these LTHs, potentially easing immediate downward pressure. Despite these instances of distribution, the overall cycle trend since late 2024 has remained upward. However, several market analysts caution that a corrective phase, potentially targeting levels between $75,000 and $97,000, could occur if market momentum falters or macroeconomic uncertainties persist. Historically, large distributions from LTHs, especially those involving a diverse range of coin ages, tend to inject liquidity into the market precisely when it is most vulnerable. This can amplify price movements, particularly when combined with negative ETF flows. Yet the scale of Friday's selling activity, while significant, is still considered within the cyclical norms rather than indicative of a market topping. Blow-off. Top, suggesting that choppy, range-bound trading might continue unless fresh demand, either from spot markets or ETFs, re-enters decisively. Can Bitcoin hold its ground amidst these shifts? We now turn to the broader market sentiment, examining ETF dynamics and how they're fueling Bitcoin's resurgence. Bitcoin's market resurgence, fueled by ETF dynamics amidst altcoin season. Bitcoin has demonstrated remarkable resilience, staging a significant resurgence that has captured the attention of investors worldwide, even as a vibrant altcoin season unfolds. The digital asset is currently navigating price levels around $109,000, showing stability after a brief dip over the weekend. This performance is occurring against a backdrop of evolving ETF dynamics and shifting market sentiment, painting a complex but ultimately bullish picture for the leading cryptocurrency. The market is closely watching how these factors interplay to shape Bitcoin's trajectory in the coming weeks. The narrative of Bitcoin's comeback is intrinsically linked to the performance and evolving landscape of spot Bitcoin ETFs. After a period of rotation that saw some outflows from Bitcoin ETFs into Ethereum funds in August, the trend has begun to stabilize. While August concluded with mixed performance and a notable outflow day on August 29th, the underlying demand drivers for Bitcoin ETFs remain robust. These financial products have democratized access to Bitcoin for a wider range of investors, integrating the digital asset into traditional investment portfolios and influencing market sentiment significantly. Market analysts are closely observing the ebb and flow of ETF investments. When ETF flows are positive, they tend to provide a significant tailwind for Bitcoin's price, signaling strong institutional and retail demand. Conversely, outflows can create short-term headwinds. The recent data showing outflows from both Bitcoin and Ethereum ETFs on August 29th, $127 million and $165 million respectively, indicates a temporary cooling-off period, possibly due to profit-taking after a strong run-up or broader market caution. However, the overall trend since the inception of these ETFs suggests sustained interest. Compounding the effect of ETF dynamics is the broader market sentiment, which appears to be increasingly favorable towards Bitcoin. Despite the volatility inherent in the cryptocurrency market, Bitcoin has consistently proven its ability to recover and push higher, often leading the charge for the broader digital asset space. The current environment, characterized by an ongoing altcoin season where many alternative cryptocurrencies are experiencing significant price appreciation, often follows periods of Bitcoin dominance. As Bitcoin consolidates or moves higher, capital tends to flow into altcoins, creating a cyclical pattern that benefits the entire ecosystem. This resurgence is also being analyzed in the context of long-term holder behavior. As previously reported, despite significant Bitcoin movements by LTHs, the overall cycle trend remains upward. This suggests that while some long-term investors are realizing profits, the fundamental strength and adoption narrative of Bitcoin remain intact. The ability of Bitcoin to absorb these larger outflows and continue consolidating at elevated price levels speaks to its growing market maturity and resilience. Furthermore, macroeconomic factors continue to play a crucial role. Easing inflation concerns and the anticipation of potential interest rate adjustments by central banks globally can create a more favorable environment for risk assets like Bitcoin. While specific market data points like the Nikkei 225's movement influenced by trade tariffs and legal rulings, and gold's performance driven by rate cut expectations, provide a broader economic context, Bitcoin's independent adoption drivers, such as institutional interest via ETFs and its growing use case as a digital store of value, remain paramount. The interplay between ETF flows, shifting market sentiment, the dynamics of altcoin season, and the behavior of long-term holders creates a complex but generally positive outlook for Bitcoin. The digital asset's capacity to navigate these varied influences and maintain its upward trajectory underscores its growing importance in the global financial landscape. The market is keenly awaiting further data on ETF inflows and outflows, as well as broader economic indicators, to gauge the immediate future direction of Bitcoin's price. What does this mean for the average investor navigating these markets? Join us for our outro as we recap the biggest stories and give you the full call to action. That's a wrap on another action-packed Bitcoin bulletin. We saw El Salvador's Bitcoin experiment offer crucial lessons for global adoption. Hex Trust CEO Alessio Quaglini highlighted both the promise and peril of Bitcoin treasury firms. Long-term Bitcoin holders made significant moves with a 97,000 BTC outflow. And Bitcoin's resurgence is being powerfully driven by ETF dynamics amidst the altcoin season. Make sure to like this video, subscribe to Bitcoin Bulletin for all your essential crypto news, and hit that notification bell so you never miss an update. Follow us on all our social channels to stay connected. We'll see you in the next one.